Okay, welcome to another video in our course. And this video is extremely important. Triple extreme. Very important because in the mainstream media, in the financial circles, you rarely hear about risk management. But for you to be successful at investing, you have to know how to manage your risk. You have to understand that each position you take in the market, there is no certainty. There is no certain method for you to know that this stock or this currency or this commodity will go up or go in the direction that you want to. So that's why it's very important that you understand risk management, and you have to have a risk management strategy for every trade that you take. Now, risk management is often overlooked, but it's very important, and it's even more important than your stock selection or your selection of currencies. Risk management is the number one determinant to see whether you will be successful or not. Because if you are risking too much per trade or per position, you could have a string of losses in a row. And let's say you risk 25% of your portfolio on a single position, and you have four losses in a row, then you're 100% out. Your portfolio is down 100%. And there could have really been nothing wrong with your method, but you could just be at a point in the market where the market was correcting or the trade just went against you. While if you're risking, let's say, 2% of your portfolio or 1%, you would be down 4% and 8% respectively. And you will have enough capital to get back to break even. So it's often overlooked, but you have to do some math. I know some of us don't really like math. I'm one of them, but we have to do some math to determine the appropriate risk for each position. No, it's very important, as I said, no matter how good you are or think you are at stock investing or trading in general. Okay, so our system, let's expand on the system we spoke about in the previous video. The system states that when we enter a market, we are going to put a stop loss 25% below the market. So if the stock price is at $100, if it drops 25% to 75, we're out of the market. Now, the question is, we also that is our exit point. So that's what we call a stop loss. So you'll put an order in the market that, okay, if the market hits this point, I'm going to exit the market no matter what. I'm not going to move the stop loss down to give the trade more room. I am not going to interfere with it. So that is your exit point on initial entry. But you also have to determine how much you are going to risk per trade of your capital. And that is, especially when you're investing, we say that you risk maybe about 2% of your entire capital per trade. So if you have 100,000, you would only risk $2,000 per trade. You could risk less. You could risk 1%. You could risk 0.5%. But note, if you risk less, your returns are going to be less. While if you risk more, your returns are going to be more, but your drawdowns are going to be higher. So there is a optimal point that you should determine, and it also depends on what your goal for your account. So if you only want to make 5 to 10% per annum, maybe risking 1% per trade is a better bet than risking 2%. So that is a general guideline on your risk, but you have to have a risk per trade. Often investors just jump in the market without defining their risk before, and they don't realize that trading is a game of probabilities. It's not a certainty that a particular market will go up. So that's why you have to protect your capital. And it's always best to risk less than risking too much, because capital preservation is the key. So our system is that we are going to enter the market. If the market drops 25% below the entry, we are going to exit the market, and our risk on that trade is 2% of our capital. So let's go through an example. Let's say the stock price is $50. Our portfolio size is $10,000. So we have to determine the stock exit price. And using our system, a $50 stock, 25% drop in that stock would be $12.50. So if the market hits $37.50, we'll be out. And our risk is 2% of the capital. So we need to determine how many shares to buy for that, so that we are risking 2% and exit at that price. So if our price is $50, our stop loss risk is $12.50. So that's 25% below the market. Or to get your risk in dollars is portfolio size times 2%. Because we're risking 2% per trade, is portfolio size times 2% will get your risk in dollars. So with a 10,000 account, 2% of 10,000 is 200. 20,000, 2% of 20,000 is 400. 5,000 account, 2% of 5,000 is 100. So it's just plug in on your calculator 2% of your capital. Now, to get the number of shares to buy, you divide your risk in dollars by your stop loss risk, and that will get you the shares to buy. So in this case, if the price is $50, your stop loss risk is $12.50, which is 25% below the market. Portfolio size, 2%. Risk is $200. So your risk in dollars divided by stop loss risk is 200 divided by $12.50. You can then purchase 16 shares of that particular stock. So just to reiterate, you can buy 16 shares. Your stop loss risk is $12.50. So you minus $12.50 from 50, you get $37.50. So where you place your stop loss is $37.50. I hope that is fairly clear. And the number of shares you can buy is 16 shares. That will ensure that if the market goes against you, you have only lost $200, which is 2% of your capital. Let's do another example. Let's say you buy the stock price is $15. Your stop loss risk is 25% below the market, which is $3.75. Your portfolio size, let's say, is $25,000. 25,000 times 2% is 400. It's 500. Sorry, 25,000. It's like I need glasses. 25,000 times 2% is $500. So to get the number of shares is your risk in dollars divided by stop loss risk, which is 500, divided by 375 is 133.33 shares. That's how many shares you can buy of that particular stock. So it's very important that you work it out for every position you are in. If you are going to buy an ETF or stock, it's the same thing. Work out using our simple system, 25% drop. You'll work out your shares, and then as the price goes up, you will be just moving the stop loss up and up and up. What does that mean essentially? Let's say we enter at $15. And we have our game plan. $3.75 below the market. If the market hits $3.75 below the market, we are out of the market. So if the market hits $11.25, we are out. $11.25, we are stopped out. But let's say the market then goes up to $18. we will move our stop loss risk to 18, 25% below 18. So you'll move your stop loss risk as the market goes up. So the new price of 18 times 25%, and you will get your stop loss will now be at 1350. And if the stock moves up to 20, you will 25% below 20, you'll move your stop loss. So you're just moving your stop loss as the prices move up. So if the price, let's say the price double to 30, you make 100, it goes up to 30, your stop loss will be at $22.50. $22.50. Because what you're doing is giving the market room to correct. Because remember how markets move. Markets just don't move straight up. It moves up, it comes down. It moves up, it comes down. But what we're trying to do is have the stop loss far enough that if it comes down, we are not stopped out prematurely. And that is the system that we are doing. It's a basic system. If you find a different system that you can use, well, go ahead and use it. But the principle remains the same. As the market makes a new high, you move the stop loss up. But it's vitally important you define your risk in each trade. Folks, if you do the 3 steps, number 1, determine that the market is in an uptrend. First thing, and define your risk. Those 2 steps, you will be a much better investor, and you'll be better off than most folks out there that essentially invest in markets that are moving downwards because they are saying the stock price is cheap, and they don't define their risk. So if the market is moving down, they may move the stop loss down further and down further to give the trade more room, etc. So what would have been maybe a 2% loss turns into a 20% loss. And that's how it's difficult to recover when you invest like that. So that is the end of this video, and I hope you follow it because it is vitally important. Thank you.